Mic check, 1, 2. Mic check, mic check. Thank you, sir.
Thanks, sir. I'll be back in a few minutes.
Mic check, sound check for the court reporter. Mic check, 1, 2, 3, 4. Mic check, 1, 2, 3, 4. Sound check for the court reporter. Mic check, 1, 2, 3, 4. Mic check.
Mike Young. Subcommittee will come to order. Good morning, everyone, and welcome to today's Subcommittee on Economic Opportunity and our oversight hearing entitled Home Loan Churning Practices and How Veteran Homebuyers Are Being Affected, and additionally, how taxpayers could be affected. This is the second oversight hearing that we've held this Congress related to VA's loan guarantee program and the benefits that are provided to our American service members and veterans on account of this program. As Mr. London with the Department of Veterans Affairs discusses in his testimony, the VA has guaranteed over 23 million loans in excess of $2 trillion since the 1940s. That represents millions of veterans, service members, and their families who may not have otherwise been able to achieve the American dream. And while this program is one of the more well-run programs at the VA, and I have some thoughts about why it is, mainly because they guarantee it, but the lenders are involved and they underwrite it, and there are more people involved in administering it in the private sector. But they've recently had some concerns about certain activities being conducted by some lenders, potentially unscrupulous lenders, which have the potential for harmful outcomes for veteran homebuyers. But not only for the homebuyers, but for the mortgage industry and for, again, the taxpayer, who in guaranteed programs like this are ultimately on the hook. We have seen reports of what may be deceptive practices that seem to be, in some cases, misleading veterans to refinance their homes with the idea that they will have lower interest rates or be able to skip a mortgage payment or take cash out of their homes that will, quote unquote, save them money down the road. And as our dads taught us, if something sounds too good to be true, oftentimes it is too good to be true. So we've heard stories of individual veterans receiving dozens of solicitations from certain lenders in the immediate week after closing on their homes, leading some of them to believe that they will pay less cash each month if they just refinance their homes with these lenders. However, due to the realities of hidden fees, adjustable interest rates, and other products like that, the veteran can end up paying much more than they ultimately can afford, or even remove all their equity in the home, such that they end up upside down on their mortgage. These practices are troubling. They don't seem to have the best interests of the veteran in mind. They can have a negative impact on financial institutions and the investors that support them. And then most disconcerting to me, they are depreciating the value of the VA guaranteed loans and the integrity of the program, and they're potentially exposing taxpayers to greater risk. I understand that many households do experience instances where refinancing through an interest rate reduction refinancing loan or an IRRRL is necessary and appropriate for their own financial circumstances. However, we must ensure that there are appropriate standards in place to prevent unfair and deceptive practices, number one. And number two, that these products are being offered consistent with safe and sound practices to protect the integrity of the home loan program. I look forward to discussing these solutions with our witnesses today to ensure that we are appropriately protecting the veteran consumer, the integrity of the program, the taxpayer, who, by the way, has agreed to make this investment and be a guarantor for this program so that we can serve our veterans in this way. I again thank the witnesses for being here this morning, and I look forward to your testimony. And now I want to yield time to my friend, Ranking Member Beto O'Rourke.
Mr. Chairman, thank you for helping to organize this meeting, to your staff and the minority staff for ensuring that we're prepared for it. Looking forward to hearing from those who are here today to testify and to answer our questions. And as always, you've done such an excellent job of describing the benefit of the program that we seek to enhance, some of the challenges that face that program right now, and specifically the veterans for whom it is set up and administered and intended to benefit. And as we have often done in this subcommittee, which I think really distinguishes it from so much of the other work in Congress, I would love to see us, perhaps by the end of this meeting, suggest some common sense solutions that the VA could either adopt administratively or that we will work on as literally an act of Congress if necessary. I think that's something that we've been able to do in many of our meetings together with the participation of the members, input from VSOs and veterans, and the wisdom that we gain from the panel here. And so I've come in with some ideas. I want to listen to yours. I want to hear what the experts have to say. And then perhaps in summary at the end of this, we could hopefully get on the same page about how we could correct this in a way that's not burdensome or onerous, but protects veterans from fraud or duplicity or decisions that they may not be making in an informed way. So looking forward to the conversation, and grateful that you brought us all together today on this important issue. And with that, I'll yield back.
Thank you, Ranking Member O'Rourke, and I share your sentiments and the desired outcome to find out where the problem lies and what tools the folks here, the stakeholders, need to solve the problem, and then move forward with just a better environment altogether for our veterans and taxpayers. So with that, let's make introductions of those who are here to testify. With us, we have Mr. Jeffrey London, Director of VA's Loan Guaranteed Service, and he's accompanied by Mr. John Bell, Deputy Director of VA's Loan Guarantee Service. Mr. Michael Bright, Executive Vice President, Chief Operating Officer of the Government National Mortgage Association, better known as Ginnie Mae. Glad to have you here with us. Mr. J. David Motley, President of Colonial Savings, who's testifying on behalf of the Mortgage Bankers Association, an important stakeholder, no doubt, in this discussion. And finally, Mr. Brock Cooper, General Counsel for Veterans United Home Loans. Thanks, everybody, for being here, and certainly look forward to hearing from you. Let's start with Mr. London. You have 5 minutes for your opening statement.
Good morning, Chairman Arrington, Ranking Member O'Rourke, and other members of the subcommittee. Thank you for the opportunity to appear before you today to discuss the Department of Veterans Affairs Home Loan Guarantee Program and the issue of serial refinancing and the impact it can have on veteran borrowers. Making sure refinance loans provide veterans with a benefit and not future financial harm is a very important matter. No one is helped when a refinance loan ends in a foreclosure. It is also very important to ensure that VA loans facilitate healthy mortgage-backed securities and continue investment in our nation's housing market. Today, I am pleased to share with you our assessment of the situation, the activities to assist veterans that we have undertaken in collaboration with our colleagues thus far, and the sensible, impactful approach we have crafted to ensure program success. First, I'd like to give a sense of the scope and nature of the situation in our program. The vast majority of refinance loans are providing veterans with benefits. For example, one disabled veteran living on Social Security income and VA disability was able to reduce the interest rate and change terms to save over $500 a month. Another veteran, who was a police officer with 2 children, was able to reduce the interest rate and save over $400 a month. Data from the last 2 fiscal years also show positive trends. Not only did the number of veterans who obtained 2 or more streamlined refinances in a given fiscal year decline significantly, approximately 80% year over year, the number of lenders engaging in notable habitual refinancing also declined from approximately a dozen in FY16 down to only a handful in fiscal year 2017. So yes, there have been instances of lenders not using the streamlined refinance program for its intended purpose. Although we believe those instances are not indicative of a systematic problem, VA's steadily high loan volume reverberates to Ginnie Mae's investors. And of course, one veteran being misled or taken advantage of is one veteran too many. So we are compelled to act and make an impactful change. Our program's success is built on a long-standing history of employing policy actions that are appropriate for the given situation. We take measured approaches to policy interventions in complex situations. A regulation has been drafted with due care. Our overarching concern in developing the rule was to ensure that our veteran borrowers receive a net tangible benefit. In addition to analyzing seasoning requirements appropriate for streamlined and regular cash-out refinance loans, we examined the long-term costs veteran borrowers could face in obtaining them. Meanwhile, we also collaborated with our colleagues at Ginnie Mae and the Consumer Finance Protection Bureau to employ non-regulatory actions that could quickly serve veterans, taxpayers in general, and mortgage investors alike. The VA team has focused a great amount of time and energy in working with Ginnie Mae and our joint task force, which has resulted in 2 all-purpose memorandums aimed at the frequency of refinance loans. We collaborated with the CFPB on a warning order which provided veterans with important consumer and financial information to consider when deciding whether to refinance an existing mortgage. We have held a number of meetings with the Mortgage Bankers Association and their members to discuss program policy and data as they relate to the underwriting, origination, and performance of VA guaranteed loans. As the draft regulation makes its way to publication for comment, we have turned our eye to examining the impacts that recent market conditions may have on other segments of our business, more particularly the regular cash-out refinance program. We anticipate that, in response to market conditions, lenders will shift their business models to originating more purchase loans or more regular cash-out refinance loans. As a result, we will be keeping a close eye on trends in these programs to ensure they are being stringently underwritten to our established standards and the loans provide the intended benefit to our veteran borrowers. Members, despite the concern that others may have expressed about the heading we have followed and the speed at which we have traveled, I am confident that the road we have engineered is a sensible one and that it will have a net positive impact for our veterans, for lenders, and for the broader origination and secondary markets. Thank you again for the opportunity to speak to you today, and as always, I thank you for your unwavering commitment to serving our nation's veterans and service members. I look forward to entertaining any questions you may have.
Mr. Michael Bright.
Thank you, Mr. London. Now from Ginnie Mae, Mr. Michael Bright. We yield 5 minutes for your introductory statement.
Chairman Arrington, Ranking Member O'Rourke, and members of the subcommittee, good morning and thank you for inviting me here today. My name is Michael Bright, and I am the Executive Vice President and Chief Operating Officer of the Government National Mortgage Association, or Ginnie Mae. I thank you very much for inviting me here to testify on this critical issue. For background, Ginnie Mae is a federal agency chartered by Congress in 1968, responsible for providing liquidity to the market for mortgages in the Veterans Affairs, Federal Housing Administration, and USDA rural housing programs. We do this by applying a full faith and credit government guarantee to loans that qualify for delivery into our security. Qualifying loans are those guaranteed by the USDA, VA, and FHA under their respective program guides. These loans are then pooled into our mortgage-backed securities, or MBS. The Ginnie Mae guarantee and the Ginnie Mae brand is globally recognized and trusted. The strong value of our brand leads to investment in the U.S. housing market from large asset managers, pension funds, and central banks across the globe, all of which makes lending to low-income, first-time, rural, and veteran borrowers possible. It would be very difficult for me to overstate the consequences for the U.S. housing market if Ginnie Mae and our partner federal agencies, the USDA, VA, and FHA, did not successfully police our programs. Global capital is drawn to our market in part because of the strength of the United States and its creditworthiness. But if our program is abused or taken advantage of, this capital can and will find other investment vehicles. That would drive up interest rates and make mortgage credit less available for millions of Americans. As such, it is imperative that we all work together, those of us here on this panel as well as Congress, to solve the issue we are here to discuss today. We believe we are seeing abusive practices by some lenders in the VA program, namely the rapid refinancing of borrowers multiple times without significant economic benefit. We believe, and our data shows, that this practice is the result of a relatively small percentage of lenders. But importantly, it has become endemic enough in the market that it threatens the health of our security, and so action to curb this behavior is imperative. Abusive lending practices in the VA market are alarming on so many levels. First, as I mentioned before, if this behavior persists, we run the risk of losing the capital needed to fund critically important homeownership programs. Second, to watch behavior that is borderline predatory in nature return to our country is terrifying. Much of this behavior is too reminiscent of the lending practices used by many in the industry prior to the 2008 financial crisis. And finally, the fact that this behavior is targeted at veterans should be sickening to all of us. The best way to stop this behavior is to put in place more stringent rules and to say that it will not be tolerated. For Ginnie Mae's part, we have already announced that we are putting in place the following new requirements. 1, no loan can be refinanced and delivered into a Ginnie Mae multi-issuer security within 6 months of the first payment due date of the original loan. 2, no loan that is more than 150 basis points or 1.5 percentage points above what we define as par will be eligible for delivery into a Ginnie Mae multi-issuer security. And 3, lenders who are clearly and demonstrably abusing our program will be put on notice. Ultimately, under forthcoming rules, some pools will no longer enjoy the benefits of delivery into our flagship security and instead will be forced into what we call custom pools. This is a powerful tool that Ginnie Mae can and will use. Let me repeat. Issuers who produce pools of loans that perform materially different than our average will need to find their own investors. This action will help prevent the bad actions of some issuers from filtering into poor security pricing for those who use our program in a responsible manner. I believe that 2018 will be a critical year for this issue. If we cannot get a handle on this behavior, abusive lending will continue to infect our market and our program. That could drive away important sources of capital and may create an environment where veterans are viewed as suitable prey for aggressive lending. I would like to take a moment and also say to veterans that you have the right to make unwanted calls or solicitations stop. Refinancing your loan multiple times likely has consequences that you may not be aware of. And if you see terms on a loan that appear too good to be true, they probably are. Veterans should feel free to contact me or any other official at Ginnie Mae at any time if they feel they are being harmed. In conclusion, let me thank you all once again for bringing attention to this issue. At Ginnie Mae, we are here to work with all of you in doing everything that is needed to root out abusive behavior from this important loan program. Thank you, and I'm happy to answer any questions that you have.
Thank you, Mr. Bright. Mr. Motley, you now have 5 minutes.
Thank you. Chairman Arrington, Ranking Member O'Rourke, and members of the subcommittee, I appreciate the opportunity to testify this morning on behalf of the Mortgage Bankers Association. My name is Dave Motley, and I'm president of Colonial Savings, a privately held, federally chartered thrift headquartered in Fort Worth, Texas. For over 65 years, we've been originating loans for veterans. In fact, our founder, a veteran himself, saw the opportunity to serve veterans returning from World War II. Today, roughly 10% of our origination volume is to veterans, and we service over 6,000 loans for VA borrowers. I'm also chairman this year of the MBA. I'm a certified mortgage banker, and I previously served as a board member of the Texas MBA and a member of the Community Bank Advisory Council for the Consumer Financial Protection Bureau. I'd like to begin by applauding this subcommittee for its efforts to better understand problematic practices with respect to certain mortgage refinances marketed to service members and veterans of the U.S. military. The VA's mortgage loan program plays an important role in increasing the availability of mortgage credit for service members, veterans, and surviving spouses. By guaranteeing a portion of the loan balance, the VA enables lenders to offer loans with more favorable terms, such as no required down payment. While those borrowers seeking to refinance their VA loan may apply and be evaluated by their lender's full underwriting process, the VA Interest Rate Reduction Refinance Loan, IRRLS, allows for a streamlined refinance process that's often faster and entails lower costs. Generally, refinancing with an IRRL allows the borrower to lower the interest rate on the mortgage, and in doing so, the borrower incurs fees from the lender, which are either paid by the borrower at origination or rolled into the principal balance of the new loan. Recently, a small number of lenders have undertaken aggressive and potentially misleading advertising campaigns to generate increased IRRL volumes and fees. In some cases, this advertising targets VA borrowers who have just recently engaged in an IRRL, convincing them to refinance yet again to lower their interest rate by a modest amount, while adding even more fees to the principal balance on the loan. Such serial refinancing, or churning, strips borrowers' equity and often further extends the time period it takes for the cost to be recouped through lower payments. Some lenders also use the IRRL to lower the rate, but only by moving the veteran from a 30-year fixed rate to a 3-year adjustable rate mortgage. Many borrowers may not fully comprehend the net economic impact of their decision to refinance, leaving them vulnerable to situations in which they add substantial amounts to their overall loan balance while achieving only small reductions in their monthly payments. This is not what the program was intended to do, and these practices should be put to an end. Aggressive use of IRRRLs by some lenders also threatens to weaken investor demand for Ginnie Mae securities that are partially backed by VA loans. This outcome increases costs and negatively impacts access to credit for a wide range of borrowers. It's worth noting that IRRRL churning is not a widespread problem among the mortgage lending community, but rather an activity that is confined to a small subset of lenders. MBA fully supports supervisory efforts to improve the policing of the market, as well as new rules to remove the ability or incentive for any lenders to engage in churning. We applaud Ginnie Mae for taking important steps to both study and address this issue. However, the problem of loan churning cannot be solved by Ginnie Mae alone. Fortunately, many practical options fall within the existing authority of VA to implement. For example, instituting a maximum recoupment period would inhibit lenders from charging substantial fees in exchange for minor reductions in mortgage interest rates. Similarly, requiring a net tangible benefit test, which is already required for FHA streamlined refinances, could more effectively ensure that the terms of the refinance produce real benefits for borrowers. Limits on the amounts that can be added to the principal balance would reduce equity stripping. And finally, targeted consumer financial education about churning can better inform borrowers about the potential for abuse. It's important to focus on options that target churning while not impeding the ability of service members and veterans to obtain a beneficial refinancing. We recognize that the VA program is a unique program, an entitlement program for veterans who have served our country. As such, while we support quick action to limit abuses, it needs to be done thoughtfully to ensure that legitimate low-cost refinancing options for veterans are retained. MBA is committed to the promotion of best practices and standards that generate a healthy and responsible mortgage market, and we stand ready to assist in developing and implementing solutions to the problems we have discussed today. Thank you again for the opportunity to testify, and I welcome your questions.
Thank you, Mr. Motley. I yield 5 minutes now to Mr. Cooper for his opening remarks.
Good morning, Chairman Arrington, Ranking Member O'Rourke, and other members of the committee. My name is Brock Cooper, and I'm General Counsel of Veterans United Home Loans. I'd also like to thank the rest of the members of the panel here for being here today to address this issue. Thank you for allowing me the opportunity to come here before you today to discuss lending practices that impact our nation's service members and veterans. I've worked for Veterans United for nearly 10 years and have headed VU's legal department for that entire time. I'm a veteran myself and have used the VA loan several times, including an IRRRL. I have a VA loan today, and I've seen firsthand the aggressive and misleading refinance practices employed by some in the industry. Veterans United is a full-service family-owned lender. We're headquartered in Columbia, Missouri, and we make VA loans in all 50 states and the District of Columbia. Our primary mission is helping veterans, service members, and their families achieve the American dream of home ownership. We've been the nation's #1 VA purchase lender the past 2 years, closing more than 37,000 purchase loans in 2017. Veterans United now represents approximately 1 out of every 7 VA purchase loans made in the country. If I can impress one thing upon you today, it's that the VA loan is not like other mortgages. It differs from FHA loans and all other mortgage programs because it's an earned service benefit to our veterans and our active duty personnel and surviving spouses. It's part of a deep bond between those who serve and the nation these veterans pledge to defend. As we work to find solutions to the issues discussed here today, I implore the committee to examine whether or not particular solutions may result in fewer earned benefits for veterans. The VA loan program stands out as a true success story. Before the mortgage crisis, the VA loan was a little-used product, but due to unique underwriting, VA loans were the only shining light through the mortgage crisis, performing better than any other program. Today, VA loans represent about 10% of the mortgage market. The program has featured the lowest average interest rates for more than 3 years, along with the lowest foreclosure rates for about 10 years. In particular, the IRRRL program has helped hundreds of thousands of veterans save money in their monthly mortgage payments. Unfortunately, the members of the panel have stated before, some IRRLs fail to live up to the spirit and intent of this program. The idea behind the IRRL is to put veterans in a better financial position today than they were yesterday. We're here today to discuss improvements to this program that will ensure this spirit is carried out in every IRRL. From firsthand experience, I can tell you that as soon as a VA loan is made, serial refinance companies are aggressively contacting veterans and their families with misleading mortgage offers. Many of these companies don't care if it will take the veteran a decade or more to recoup loan costs and fees that swell their loan balances. We have seen many, many veterans harmed by this activity, and in many situations, the veteran is left so far underwater they may have difficulty selling their home in the future. Still others are left with adjustable rate loans that they don't understand and could result in higher payments down the road. And others have costs that could just never be recouped. We commend the VA and Ginnie Mae for their active engagement on this issue, and we salute their commitment to protecting veterans. We're here to talk about next steps. Going forward, the VA is in the best position to solve this issue without compromising veterans' benefits. However, the VA is inhibited from moving forward with solutions due to administrative requirements that are a part of the VA program. Unlike VA, other agencies such as Ginnie Mae, Fannie Mae, Freddie Mac, and FHA can make changes more quickly. We support legislation that would empower the VA to make program changes in a similarly expeditious manner, potentially including seasoning and recoupment periods for IRRLs. Additionally, policymakers should ensure that non-cost-saving reasons are considered through the process to protect benefits of our deserving veterans. Thank you again, Mr. Chairman and Ranking Member and the committee for allowing me to come before you today, and I look forward to questions.
Thank you, Mr. Cooper. I now recognize and yield myself 5 minutes. I may have to leave early. I'd rather yield to my colleagues, but in the event I have to leave, I wanted to go ahead and put my thoughts out there and ask you guys some questions. I spent 4 years as a regulator here in Washington during the Bush administration, George W. at the FDIC, and you know, my philosophical view of regulation is that the best way to regulate in a private market is to have full transparency and robust competition so that people know what they're getting and they have choices. Because presumably if people are buying things, if they are choosing to enter into these transactions, there must be a need. There's no market if there's no need. And I think that you know, Mr. Motley would understand that being in the industry. But this isn't a private market. This is a government market. Explain that to me more, Mr. Bright. Explain the difference between the sort of light touch, limited intervention with this sort of transparent, robust competition that free marketeers like me believe in and rely on as the best way to weed out the riffraff. Now we got a government market. What's different about it? What is skewed in that dynamic?
Yes, sir. Thank you for the question. It is true that in the mortgage finance space, in particular in FHA, VA, and USDA lending, you know, the term market we use a little bit loosely because you have originators who are originating a loan and they're purchasing government insurance on that loan. In this case, in terms of the VA, and then they're purchasing another form of government insurance to wrap the mortgage-backed securities. So you have actually two taxpayer layers of involvement to ensure that, you know, there's no credit risk at the end product.
So the full faith and credit of the United States government is now brought to bear in this.
Absolutely.
We created this market with the full faith and credit of the taxpayer backing up, not just once with the guarantee from the VA program, but with Ginnie Mae.
Yes, so absolutely a policy decision was made that we want to, as a country, make sure that, in this case, veterans, but in the FHA's case, low-income Americans, have access to loans on terms that they otherwise would not have. And in order for that to be successful, we have to police our program. So we've created, as you say, a double-layered government market.
So in the absence of a robust market forces, we have to play a greater role to protect those stakeholders, but namely the veteran and the taxpayer as the backstop here. What is so I'm curious, is this an issue of safety and soundness for the program, for the taxpayer ultimately, or is this an issue of consumer protection, or what we might refer to as an unfair and deceptive practice?
Yeah.
So let me ask Mr. Cooper, are they disclosing, these folks that we're talking about as churners, are they disclosing that they're churning? Are they disclosing everything that they're going to do, or are they being deceptive and unfair in your opinion?
If these things are deceptive initially, but I can tell you that we see disclosures that come through that don't put the veteran in a better financial position. So they may be disclosing it, but we feel like that they're being pressured to make these loans in certain situations.
See, here's my problem with that, and I mean, I feel like our veterans are some of the toughest, mentally strong, mentally competent, mature, wise. These folks have borne tremendous responsibility, and now all of a sudden, if somebody's disclosing things to them, I have a hard time believing that they're being necessarily taken advantage of. They may, but I struggle with that. Now, if they're being deceived and folks are holding out to do one thing and then they're doing another, that's a problem. And if you can't stop that at the VA and Ginnie Mae, let's figure out how we can have an act of Congress to do that. But to suggest that they can't fend for themselves when reading about what they're getting into, I struggle with that. My last question, I'm going to yield to my colleagues, that's on the consumer protection side. So if there's not the disclosure, if there's not transparency, we need to know that. And if you don't have the tools to deal with that. The other issue is the safety and soundness. So whether they're disclosed fully and they're completely transparent or not, and know what they're getting into or not, if it puts greater risk to Ginnie Mae and to the VA, and i.e. the taxpayer, that is a real problem for me regardless. So would the panel just kind of opine on that? I'd ask Mr. London and Mr. Bright to just make some comments on that, and then I'm going to yield to the ranking member for his remarks. And thanks for being a little generous here on my time.
Yes, Mr. Chairman, thank you for the opportunity to respond to your question.
And by the way, if you want to also comment on what I said about the veteran reading and understanding versus deceptive, I think there's a real difference there, so feel free to opine on any of what I said.
Sure, and I have to start by saying, like, you spent 4 years at the FDIC, 4 or 5 years of my time with VA was in oversight and compliance, so I share your sentiments about making sure that there's safety and soundness in the program. That's just built in my DNA. And if you look at the outcomes that our program has, the numbers do not lie. The VA program is a sound program. Mr. Cooper mentioned that for the last 10 years, we've had the lowest foreclosure rate and the lowest serious delinquency rate. That's an indicator of the safety and soundness of our program. And as I mentioned in my opening statement, the actions that we have taken over the years to ensure that we continue to have those type of performances is exactly what we need to do for the issues that are brought out today. So I do believe that VA has a statutory authority to address the issues. I agree with you about consumer education, and our veterans can make sound decisions on their own. It's our job in the VA to make sure that we give them the tools to make those decisions.
I agree. I would add, it is entirely true that the VA loan program has low delinquencies, and I think that that's a testament to the VA. I think it's a testament to the deal that officers and enlisted folks make with themselves when they apply for this program. There's a very strong sense that, hey, this is an earned benefit, but we have to continue to earn this benefit by performing on our loan. The problem is that, and that's a great pact. The problem is we have some lenders who don't seem to be living up to that pact as well. Absolutely, this type of behavior puts taxpayers at risk in a couple of very concrete ways. The first is that at Ginnie Mae, we wrap the mortgage-backed security. Our recourse, meaning if a lender fails to remit principal and interest on time, we have to make that payment for them. Okay, whether the borrower makes it or not, if a lender fails to make it on time, we have to make that for them. That's what our guarantee is. our asset, the asset that we have recourse to, and you as a former chief of staff of the FDIC understand, you go in and you pull out an asset in the case that an institution fails to live up to its obligations. Our asset is the MSR, the mortgage servicing rate. When we have prepayment speeds that are inexplicable by any economic measure whatsoever, what that does is that drives down the value of the mortgage servicing rate or the MSR, which means the collateral that the taxpayer has access to and has recourse to in the event that our counterparty fails to live up to their obligations, that asset is declining rapidly in value because we have issuers who have prepayment speeds, where their entire book turns over in 6 months. And so it's a technical issue, and I don't mean to get too weedy on it, but absolutely 100%, the asset that Ginnie Mae has recourse to falls in value because of this behavior. And then the final small point would be if you have lenders who are solely in the refi business and that goes away, those lenders face insolvency. And when they go insolvent, that's when Ginnie Mae's wrap kicks in, and we have to go in there and take their book. And as I just explained, the asset that we're taking is just fallen in value. So this is a full ecosystem degeneration thing that we've got going that is separate and apart from the veterans who are doing a very admirable job of paying their loans on time.
Yield now 5 minutes and as much time as you may need, actually, to ask any questions and make any comments, Ranking Member O'Rourke.
Yeah, thank the chairman and take his point about ensuring that there's transparency and adequate information for the consumer, in this case a veteran, to make an informed decision. As someone who's purchased a home with my wife, and I'm not a veteran, nor is she, and we've refinanced our home, I do have to say you are battling a mountain of that transparency and information. And I would be lying to you if I told you that I read every single page that I signed. I didn't. We trusted those who had helped us to facilitate the sale and the mortgage. And so when you pit the veteran against those who would practice churning, serial refinancing, abusive lending, and they've got their marketing teams, they've got the folks in the in the call rooms who are calling these veterans within days, maybe hours after they have already refinanced a loan. I think we need to do more than just ensuring that they have information. And I wonder if there's a way to prioritize this information. And Kathy, if you don't mind, I'll disclose you and I were talking about this yesterday and talking about whether there's just one page with 4 bullets on it in 16-point type that says, this is your principal right now. This will be your principal with the refinancing costs that you will incur if you move forward in this process. This is the consequence. I mean, no more than those 4, not in 9-point type, not in addition to everything else. Especially if this is your 2nd or 3rd or 4th refinancing, here's how your principal has grown over that time. And then if you want to make that very bluntly informed decision to proceed, so be it. You've assumed the risk with the taxpayer backing that up. And so I wonder if that might make it a little bit more of a fairer engagement between the veteran borrower and the originator of the mortgage. Mr. Motley, you said the net economic impact, which is what I'm trying to get at, may not be understood by the borrower. And you said perhaps some more targeted consumer information. Are we getting at the same thing in terms of this prioritizing, like, look, this is what you're about to take on. Want to make sure you're good with it because it may not be clear from what the person trying to sell you on this originally told you.
Yeah, thank you, Congressman. I think we are moving in the same direction there. I believe that some sort of a net tangible benefit test that is shown to the veteran is the way to go because it's going to show him what the actual costs associated with that new refinance are going to be against the time frame that it's going to take to recoup those costs through lower payments. And so if that time horizon is outside of his time horizon, then that deal makes no sense for that veteran. It's a decision, though, that he can make or she can make. So I think that there's definitely a need to establish some kind of a net tangible benefit test, similar to what the FHA has, to demonstrate to the borrower that this refinancing makes some sense. And if we have that in place, then you either abide by it or you don't abide by it. And if you don't abide by it, then you as the lender are subject to sanctions or maybe getting out of the program. But at least you've provided that disclosure to the borrower, and he's been able to make that decision himself based on his circumstances, his terms, and his expected term of living in that house.
Yeah, and so Mr. Motley's talking about consequences to bad actors in the system. Mr. London, can you talk a little bit about that and how we hold people accountable for churning and taking advantage of veterans who may not be told in the clearest or necessary terms just what they are taking on?
Sure. Before I answer that question specifically, I do want to touch base on what you're talking about the disclosure, and share some good news with you.
Great.
Today in our program, we have a requirement that lenders do exactly what you described. We call that the Earl worksheet, where on the company's letterhead, they have to disclose the terms of the loan to include the recoupment of that new transaction. So we do that today. Unfortunately, what happens is the veteran gets that at the closing table, like you described, with a mountain of paperwork that they don't read.
Right.
So a decision that I have already made is to ensure that that disclosure is provided up front to the veteran. VA will also get a copy the same time the veteran gets a copy, so that we can be that partner with the veteran if he or she has questions about those terms, that we can advise him or her and they can make their own informed decision. That's something that I can do today administratively without any regulation or statutory changes.
When does that start?
We have to make some system changes, and obviously we have to put out some guidance to lenders on what information we need to make that happen. And my goal is to have that happen this year, this calendar year.
Okay. Seems like, again, you know this far better than I do, seems like a relatively easy fix to make. And first of all, thank you for doing it. And I love that it wouldn't require an act of Congress to get that done. So first and foremost, thank you. Secondly, the sooner the better.
Absolutely.
Obviously, right? And we'd love to be kept apprised of your progress on that. And maybe just to the staff, if we could have something that triggers a request to see what the progress made on this is within the next few months, I think that would be helpful. And then lastly, that again, and sorry to be so specific on this, but the larger that information is made, and the less surrounding information within which it is buried, the better chance that the consumer is going to understand exactly what those consequences are. But I love the idea that you're going to move this up to the front of the process, and I think to the chairman's point, you're going to have a much more informed, much more transparent transaction. So I think that's good news. I'm going to yield back to the chairman, but I do hope that in the questions from the other members, we get to hear from Mr. Cooper. He said that he had some specific program changes in mind, and I'd love to know what those are as well. But thank you, Mr. London.
Great line of questions, and now we'll yield 5 minutes to Mr. Banks for any questions he has.
Thank you, Mr. Chairman. Mr. London, my wife and I's experience with our VA loan has been tremendous, and we appreciate the service that we've received through the process as we've taken advantage of that opportunity for us as a family. But I wonder, could you tell us what level of attention have some of these problems been raised to the higher levels of your organization's leadership? Has Secretary Shulkin been briefed? Is he well aware of these issues? Is he in tune with your strategies to combat them?
Absolutely. Myself, as well as the Acting Secretary, has spoken to the Secretary about this very issue, so he is personally aware. Also, our Deputy Secretary is well versed on this issue, and in fact, a couple weeks ago, met with Mr. Bright and others to discuss this issue. So this issue has the attention at the highest levels of VA, and they are extremely supportive of what we are doing.
Very good. I appreciate Secretary Shulkin's leadership more and more every day, and that testament of his interest in issues like these is a great compliment, even more so of his leadership. Mr. Cooper, I wonder if you could talk about your company's ethics, how you arrived at a place to be an ethical company, not to take advantage of some of these predatory examples that we've heard about in the testimony.
Sure. Thank you, Mr. Banks. That's a great question. We, as a company, are based on a set of values that we worked really hard on as a group, as all of our employees, to set how we wanted to act as as a company, and we carry that out every day. And it's something that we believe strongly in, and we came up with a mission as well that we want to help get veterans into homes. And we're very focused on that. We offer IRRRL refinances, we offer traditional cash-out refinances, but our marketing practices don't focus on bringing those people, right after closing to churn through them. And that's just something we felt is always in the best interest of, we're looking out for the best interest of the veteran in what we're doing. We feel like is we want to educate veterans on the VA loan and how they can best make use of the program.
Have you seen a decline in those values among your competitors during your time in the industry?
I wouldn't say that I've seen a decline. I think the other members of the panel have said that there are a few actors out there, and this is not something really new. It just becomes more prevalent when certain market factors change, interest rates tick up slightly, and or tick back down. It's very interest rate dependent, and so.
So what would be your advice to us? How do we model those ethics and values that your company has taken so seriously in your business, and in hopes that other companies will adopt those values as well?
I mean, I think that in and of itself is very difficult to from a congressional standpoint to model. I like what the chairman has said about the veteran being able to make decisions for themselves. I like the idea of disclosures. Being as transparent as we can be. There's always room for improvement in that area. I really like what Mr. London was saying about the VA being able to step in. They've been very successful with that kind of process on early intervention for servicing. And so if they implement a similar process there, I think that can be very helpful to kind of rein this activity in.
Okay, thank you. You give me great hope that other companies will emulate the same values and principles that your company does as well. And at the very least, our hearing today will publicize that, give a public hearing to those thoughts, and hopefully some of your competitors will raise that threshold as well. So thank you very much, Mr. Chairman. I yield back.
Thank you, Mr. Banks. Now yield 5 minutes to the gentleman from California, Mr. Takano.
Thank you, Chairman Arrington. And Chairman Arrington, I just want to express my gratitude for this hearing. I'm impressed that you're focusing on an area of consumer protection and that you've made this distinction between an absolute free marketplace and a government marketplace, and that the government marketplace is defined by money that's backed by the taxpayers or subsidized by the taxpayers. And therefore, the question of the veteran being able to make a complete decision all by himself is a bit modified here, because that veteran is not making a decision that only solely affects his or her assets. It's also the assets of the taxpayer that are at stake. So we have a duty to make sure that the program is set up properly, and that there isn't, I'm forgetting the term, when there's a moral liability, there's a lack of moral hazard. There's a moral hazard here because the risk has been reduced greatly on the person benefiting from the decision. I hope, Mr. Chairman, we can hold some hearings into another area where I think the government marketplace distinction applies, and that's in our educational benefits. I'm disturbed that in another committee forum, there's a proposal to do completely away with 90-10 and allow educational institutions to take 100% of their revenue from the federal government, including federally backed student loans. So I hope we could delve into that area. But I want to ask this question of I can't see the name back there, but the guy at the end. Mr. Cooper, as we approach this issue, I want to be careful that that any action we take does not have any unforeseen consequences. And one proposal that has been discussed is capping lender fees and tying the cap to the benefit of the loan for the veteran, so that the lender would not be able to collect fees in excess of what the veteran saves over a period of time. Now, would such a proposal or others like it to cap origination fees somehow help this problem of loan churning, or do you think that as long as there are any fees permitted, lenders will still seek to churn?
Thank you for the question. I believe personally that there are already restrictions in place in the amount of fees that can be charged. The difficulty becomes when you're buying down the interest rate in form of discount points that can then be rolled into the loan. Those things become another disclosure issue. It's how far down did your rate go when you purchase these points, so to speak. And so I think it does fall in line with the other pieces that we've talked about already, is that there may be other ways to handle it. I don't know specifics of what the caps might look like in addition to what's already there, but it could be one solution.
Mr. London, have there been financial service organizations have been fined by the VA for predatory behavior? Is there an ability to do that, and have they been fined at all?
We do have some ability. We have civil penalties that we can apply, but that is in reference to lenders who actually try to defraud the veteran or to mislead the government through forgery. So it's very specific.
Very specific.
Yes.
But does Ginnie Mae, can someone ask about Ginnie Mae being able to have this capacity in an analogous circumstance?
We do have a decent amount of authority at Ginnie Mae in terms of policing access to our security, and that's authority that we have been using and are going to continue in the next weeks to expand.
Can you tell me whether or not you have actually fined companies for this analogous?
We have fined companies for violation of our program in this space, yeah.
And do you publish the names of those companies that you have fined?
No.
Why not?
I don't know, but I will find out, and I'm happy to speak with you offline with that specific information.
Mr. London, would this sort of authority be useful to the VA if we were able to provide that authority?
We'll be happy to meet with you and your staff. Provide technical assistance for any type of legislation that you think may be helpful in this regard. We're ready to assist you.
I would be interested in meeting with both of you offline and to discuss this matter further.
Thank you, Mr. Tucano. And now yet another gentleman from California, Mr. Correa. We yield 5 minutes.
And thank you, Mr. Chairman, for having this most important hearing. I want to thank the folks here as well. Just a little bit about my background. I'm a licensed realtor and a former loan broker. And gentlemen, as you know, this can be one of the dirtiest businesses that there is out there, real estate loans. And Mr. Cooper, have you ever had to fire anybody?
I have not personally had to fire anyone, no.
That's impressive, because most of the time there's a lot of bad apples out there, and you end up firing folks out there because sometimes it doesn't matter what your mission statement is, the interest of making a buck sometimes outweighs the interest of following your mission statement. In reference to what my colleague, Mr. Tucano, brought up, which is, do you put this online? State of California, if you have a doctor that is civilly fined, that goes online. The Bureau of Automotive Repairs, any violations go online. So you as a consumer have any issues, you immediately go online, see who the heck it is that you're dealing with, and that information is disclosed to the world. It's not rocket science, folks. We can do this very easy. You know, it's very hard also to try to second guess the economic motives, the financial motives for a veteran to refinance. Is, you know, buy downs, interest loan, fees, points. And as you know, sir, sometimes what these folks do is they'll give you discount on the points, but they'll jack you up on the fees. And at the end of the day, you get hit one way or the other. It'd be interesting if we come up with, not rocket science, but an application, an app somewhere, so a veteran can, consumer can punch in a couple of numbers and come up with it. This is good or bad. And another question I would have, Mr. London, is do you keep records of the folks, the loan originators, and how many loans that they're originating so that you can detect whether there's a pattern there of churning or not?
We do keep a record of every loan that is originated, but I'm glad that you asked that question, so thank you for asking. Because one of the things that Mr. Cooper mentioned was that we have on the back end, if you will, for servicing of loans when a veteran goes into default, we have a comprehensive system where on every single defaulted loan we have tremendous amounts of data so that we can see exactly what the servicer is doing and we can intervene on a veteran's behalf if we need to. Unfortunately, we don't have a system like that on the front end. However, we have recently led a contract where we're re-engineering that entire system that I just described, and we're building the capability on the front end to get information on every single loan origination that have the same type of intervention and monitoring that we have in servicing a loan. So we are very close to having that.
And I'm glad to hear that, and I'm hoping you put as much of that information in line for, and you direct our veterans to that website so that they can be a better educated consumer. Good faith estimates, don't we still have those out there that when you originate a loan, you give people something that says what that loan's going to cost them? Do we still have that?
Yes, the borrower will get what's called a loan estimate with that type of information.
And again, I hope that you keep some kind of a database, work on it up front so that if any of these folks are out there originating loans and you begin to see a pattern that every 2 or 3 months they're, churning a loan, and if you can look at it then whether they're doing it for their own benefit or the consumer actually benefits.
Absolutely.
A lot of neat stuff we can do here to protect our veterans. Mr. Chair, I yield.
Thank you, Mr. Correa. I'll yield myself another 5 minutes. I think this has already proved to be a very productive discussion. I think we should continue it. Most of my thoughts and comments and questions were philosophical. I mean, I just truly believe that choice for the consumer and disclosure is generally the best way to regulate. Again, and Mr. Takano articulated it better than I could, the market is skewed because government has intervened. In fact, without government or the taxpayer, there wouldn't be this market, presumably, because if there would, we shouldn't do it. So now comes the question of, so we should regulate and engage more readily in this on behalf of the taxpayer. And certainly if there are ways to have better disclosure and a simpler, easier way to digest what product and transaction that they are about to engage in, by all means, I'm hoping you guys are reviewing that and constantly thinking of ways to do that. Although oftentimes more regulation to protect the consumer ends up with more paperwork for the consumer and I think makes it more difficult and burdensome. But I would like to see that new disclosure product that you guys are working on and as the ranking member suggested, if y'all could submit that, it'd be good for us all to look at it. But trying to regulate in this space away those products that we deem bad for the veteran because they're churning because of some definition that we agree is bad, versus and doing that without diminishing the opportunity for products that they may need. Real products that are good, safe, sound, useful to the veteran so that they can maybe lower their payments. Maybe they need to lower their payments. Maybe they know exactly what they're doing and they need that. Help me, Mr. Motley and Mr. Cooper, tell me where the line is, where it's a good product, it's useful, it's safe, it's sound. I mean, there's always a transaction cost for the institution, and if there's more risk, then the institution has to charge commensurate with the risk. We see that in payday loans all the time. I know folks that without a payday loan couldn't fix their car and go to work again because a bank won't finance them. So anyway, what are your thoughts about the line between the appropriate and sound versus the not-so-sound churning? Where is that? Define that for me.
Well, it's really not that easy to define because every situation is different. I think, as Mr. Cooper said earlier, we try to look at all of our borrowers in terms of what's best for them. What's the best outcome for them, for their particular situation? You have to take a lot of things into account. And so I think that you want to have guardrails put in place on any program to avoid abuse. And you want to have transparency. So your point about a proper disclosure is a good one. And having it done up front is also a very good one. But I think that we have to balance additional regulation with the benefit of that and the onerousness and the extra cost of providing additional disclosures. But I think that the main point is that if we are sure that the veteran is benefiting from the refinance transaction, and we can do that by showing what the costs are, what the payment reductions are, how long it's going to take him to break even on that transaction, and if that makes sense in his situation, then we should have satisfied the net tangible benefit test and satisfied VA that we've done the right thing for that veteran.
So let's assume that we can define a reasonable, useful, sound product or transaction that allows the veteran to benefit. And the costs are commensurate, they're built in, the fees commensurate with transaction cost. I mean, so let's say we can define that. Do you all, VA and Ginnie Mae, have the authority, legal authority, to define that and to regulate in this space in that regard? Do you have the legal authority? And cite for me the legal authority. Because here's my thing. I want you to appropriately, because of the taxpayer, and I think it is sometimes necessary and appropriate, but I don't want you to make it up. I don't want you to just create it out of the ether. And so if we, as Congress, do need to act to give you that legal authority, that's the way this thing works, as you know. So do you have the legal authority? Cite the legal authority for me, both you and Ginnie Mae, please.
Yes, sir. Thank you for the question. As I mentioned, we have a draft regulation that we believe is a measured approach to address this issue, and the specific statutory authority that we used, there are several. 38 U.S.C. 3710 is one, specifically subsection E. You also have 3703 C and 38 U.S.C. 501 are the three specific statutory references that we believe gives us the authority to regulate this issue.
And summarize for me, if you would, what that legal authority is, if you can. I mean, I can go back and look it up, and everybody here can, but give me one of the three, the best nexus to that authority from which you would promulgate a rule to define this net tangible benefit.
Sure, I'll be happy to provide you more detail for the record, but the one that I will choose that gives the agency its broadest authority is 38 U.S.C. 501, and that specific reference gives the Secretary the authority to regulate VA programs across the board, and the other two references that I gave you were specific to the loan guarantee program. Okay. Again, I'll be happy to provide you those details.
I've taken too much time already. Thank you for the answer, Mr. Ranking Member. 5 minutes.
I think Mr. Motley made a really good point about ensuring that we do the right thing for the consumer without overburdening the lender. And I've heard from many lenders in El Paso about how really well-intended legislation to rein in the too-big-to-fail institutions inadvertently hurt the smaller independent originators. They make a really good, compelling case about, look, we know the community best, Beto, and when you make it more expensive and harder for us to originate, then those who don't know the community are left with those choices, and you see less capital coming into the community. So your point is very well taken. I will say, just in the example that we discussed and that Mr. London has committed to in terms of prioritizing the net economic impact disclosure at the outset, and the O'Rourke addendum to that it be in 16-point type so that it's like really easy to see and you know what you're getting into. Doesn't seem incredibly burdensome or onerous. Seems fair and seems very workable. Again, from my perspective, not knowing your all's business as well as well as you do. So I hope that you could agree with that, or that the industry would see that as well. But your point's well taken, that we want to make sure that we don't in any way undermine the ability to get these loans made or these refinancing transactions completed for those who would benefit from them. You know, one of the last things I think, Mr. Chairman, that we need to do is make sure that we're hearing from veterans on these proposals and the veteran service organizations who advocate from them. I want to make sure that there are no additional suggestions or ideas or proposals that have gone unheard or unimplemented, because in Texas alone, we see just last year 60,000 total home loans. 21,000 of those were refinances, and we want to make sure that we are advocating and protecting those veterans who have done everything we've asked them to do and have earned this, and that we're able to follow through on it. And lastly, I want to say this, Mr. London, you really are a breath of fresh air. I just left the GAO high-risk list roundtable about VHA being able to implement corrections that will improve access to care. And some of the responses we got, well, we're gonna have a conference call on this. You can see something later this year. And in some cases, we've seen no progress on any of these. So the fact that you came to this meeting with action already undertaken and specific proposals about what you're going to change, for example, moving up this information to the outset of the transaction instead of the moment when you sign and you're under all that pressure. Very refreshing. I love seeing that, and I hope that you'll follow up on that by keeping us informed of your progress on implementing this. I think we all agree sooner better than later, and then would certainly love to hear back from the industry and most importantly, veterans on the efficacy of those efforts. So thank you all for what you're doing in your testimony today, and I'll yield back to the chair.
He's not here. Mr. Takano, 5 minutes.
Mr. London, and who's the guy from the Ginnie Mae? I can't read your name. Mr. Bright. Mr. Bright, when we say that Ginnie Mae is able to find companies in this space, does that space include the VA? I mean, I understand it. The Ginnie Mae and am I misunderstanding that the VA and Ginnie Mae operate in partnership and together to operate this program?
So Ginnie Mae has the authority to issue rules that pertain to lenders' ability to access our security. And so we have broad statutory authority to write rules for access to our security, you know, as we need to protect it. So if you actually look at Ginnie Mae's charter, of our top 5 mandates, the first 4 relate to making sure that there's liquidity in the mortgage market and the ability to promulgate regulations to ensure that liquidity maintains in the mortgage market. Once we issue a rule to our issuers or the lending community and say, here are the rules that you need to abide by, we have about an 800-page issuer guide. If there are violations of that guide, we can issue civil money penalties. So our rulemaking ability is pretty much restricted to the ability to access the Ginnie Mae security and under what terms. We really can't issue civil money penalties for violations of the VA program itself. That would be the VA. Nor can we issue civil money penalties for violation of consumer protection laws. That would be CFPB or the FCC. So what we've been doing in those cases is when we see instances where we think it's possible that some of those laws are being violated, we're making referrals to those relative agencies. So our CMPs they pertain to violations of the rules that we put in place for access to our security.
Mr. Cooper, you said earlier that during the financial crisis that overall the VA home loans held up the best. To what do you attribute that?
Thank you for the question. We attribute that to the underwriting that was in place from the VA from well before the crisis, and specifically the way the VA looks at it is not just at how much, what's their payment, what's their DTI. They're also looking at the back end of like how much money do you have left over, their residual income. And so that's a really essential part of the program. Residual income, it protects the person from, at the end of the day, they still have money to live their daily life, and then they're still able to, hopefully then they're still able to make their mortgage payments. That has been a really big part of the VA program it's different from any other program that's out there. No one else requires that.
Mr. London, again, as we look, do you have any other thoughts on appropriate regulation or appropriate authority that you might need to police the bad actors that we're talking about today more effectively?
Sure. As I mentioned in my testimony, we have a draft regulation that we believe will take into account the very recommendations that you heard from other panelists today. We evaluated things like a net tangible benefit, seasoning requirements, and recoupment requirements, and many other actions to see what will best handle the issue. But I definitely have to get one point on the table. And all the panelists agree that we're talking about a relatively small number of lenders
I realize that.
who are involved in this. And the fact that we have drafted a rule very carefully that's going to not only impact those small number of actors, is also going to impact every single veteran's, potentially, their access to his or her earned benefit. It's going to have an impact potentially on every single lender and servicer that participates in the program. And as Mr. Bright and others say, it's also going to have a downstream effect on mortgage investors. So there's not just one answer or one thing that can be done. We looked at it holistically. And as I stated to the chairman, we believe we have the statutory authority to regulate those in those areas.
And you haven't published it yet because it's draft. And so is there kind of a comment period from the public that has to be undergone before it's implemented?
Yes, the rule is currently drafted as a proposed rule, and there will be an opportunity for public comment.
And you don't have any idea, I mean, you've been taking input from the industry on crafting the rule?
Absolutely. The good news is in analyzing and thinking about the rule, we met, as I mentioned in my testimony, we met with the Mortgage Bankers Association and their members and many other stakeholders as we were contemplating and evaluating what policy actions we needed to take under this draft regulation. And obviously, we will welcome additional comments that anyone has to offer once the rule is published.
Oh, and when do you anticipate the rule being published?
Unfortunately, I don't have a specific timeline for you today, but I am happy to report that the rule, as I say, is in final draft, and that's a good indication that we're very close to having it publicized in a relatively short time frame, but I don't have a specific time frame for you today.
All right. Well, thank you very much, and I yield back, Mr. Chairman.
No closing comments? Mr. Takano, I'll give you more time if you have any follow-up questions or comments.
Mr. Chairman, just thank you very much for the spirit of this hearing, and I congratulate you on that, and I hope we can continue the work in this vein.
Yeah, I think.
And I respect your free market. I really do respect your free market views. I actually do entertain the thought that some of these products could be useful to some veterans, and we don't want to be overly aggressive in regulation. And but again, we're talking about taxpayer resources that we have to protect.
That's right. That's right. And you know, it's good that we can agree like this, huh? Let's somebody get a picture. Is somebody recording this? No, it's true. I mean, this is a space where we need to engage on behalf of the taxpayer because of the full faith and credit, and we need to strike that balance. And that's why I asked the question of defining it. You know, how do you define this? Because if somebody was charged any fee, they may say, hey, I shouldn't be charged for this, but there's a cost for the institution for that transaction. So, you know, what is that threshold that's unreasonable and abusive and not a tangible benefit? Well, I feel like I've heard enough to know that the stakeholders, including the industry, can strike that and in fact have, and I give you credit, and join the ranking member in his praising you and your team for the way you've conducted your business. It's best that a regulator engages the stakeholders prior to public comment. I mean, you're going to have agreement here, it seems like, and we're talking about a few potentially bad actors, potentially, and maybe not bad actors. Maybe they're just playing with the rules that exist. We just need to tighten them up so that we raise the bar of what we expect for safe and sound practices and the protection, if you will, and minimal standards for fair practices. In this space, I'm curious because the FTC should be able to regulate unfair and deceptive practices. Have there been any cases referred to the FTC where there's been unfair and deceptive? And I understand there's lots of things going on here. They could disclose better, so let's do that. There is safety and soundness for the taxpayer and the program, but then there's real deception and unscrupulousness by offering one thing and it be really another thing. Have those been referred to the FTC, and have they acted upon those? Mr. London?
I am not personally aware of any referrals that have been made.
Mr. Wright?
Yeah, what we've been doing is collecting solicitation materials that are generally from actually brokers, not lenders themselves, but then what they do is they originate these loans and then sell them to a lender. And what I'd love to do is, we've got a pile of them. So I've asked all of the veterans at Ginnie Mae to sort of collect these solicitation materials that they get. I'll share them with you. They're not lies. They're just, you'll understand. We'll sit down and talk to them.
Yeah, so I'm trying to be real careful, even in this hearing, to not say predatory and deceptive, because the FTC ought to pursue that and bring the full force of the law against people that are doing that. And then where we need to tighten it up, where there's some fastness and looseness, that's what you guys can do. And then again, for me, ultimately, the safety and soundness of the program. This is offered because the taxpayers allow this to happen, because they love their veterans and they want them to have this benefit, but they want it done in a safe and sound and a fiscally responsible way.
Mr. Chairman, if I may, can I amend my
Yeah.
comment that I made, because your question was specific to the FTC?
Yes.
We have been working very closely with the CFPB on veteran complaints that we have received about the solicitations that they've received, and we have made those referrals. So I just wanted to make that distinction, that we have provided information to the CFPB, but not specifically to the FTC.
Okay. Thank you. Thank you, colleagues. Great discussion. Let's continue in in your efforts as you described to tighten up in this space, and let us see whatever draft documents just for our information as the ranking member requested, if you would, and continue to notify us if you need the authority where you don't, and don't regulate where you don't have the authority. That's not your job. That's the United States Congress job, Article 1. But I feel good about what I've heard today, and so good hearing. This now concludes our hearing, and I ask unanimous consent that all members have 5 legislative days in which to revise and extend their remarks and include any extraneous material on today's hearing. Without objection, so ordered. Thank you all again for being here today. Great hearing. God bless.